going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this weekend. So what we're going to be covering in this update video is a little bit of an analysis on what I've been seeing on some of the data points that we've been looking at over the last couple of weeks and months. Things are starting to kind of trend in our favor right now. And the main concept that I really want to look at and go over with you guys in this update is forced share recalls. Now, there are a couple of key discrepancies and key things that I want you guys to understand about forced share recalls before we actually get into some of this data. So we're going to go into that first, but I don't want to waste any of your guys' time. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, guys, if you want to learn that 1348 strategy that a lot of people are absolutely printing with, make sure you check out that link down below to join the Discord if you would like to. I am going to be coming out with a 1348 video most likely this weekend, so make sure you stay tuned for that. So AMC closed on Friday at $14.30, down another about 6.6%. That's absolutely not what we want to see, but what I kind of want to just drive home to you guys right now is that, one, when we think about this AMC GME short squeeze situation as a whole, what we need to think about is that, one, the short interest is still at very, very high levels. Two, the fundamentals of AMC are continuously getting better. Now, those fundamentals are going to take a little bit of time to play out. Now, I know a lot of people like to say, well, it's not a fundamental play, it's a squeeze play. If it was just a squeeze play, you could go chase any other stock with a super high short interest and hope for the best on the squeeze. The reason why AMC and GME and all these other stocks have so much potential is because we as apes believe that the market is not reflecting all accurate information about these stocks, and the shorts are piling in trying to push this down. And again, if you do want dividends to come eventually, well, the fundamentals are going to have to come as well. And additionally, we also have this Russia conflict, the fear over rate hikes, inflation that is just kind of driving the markets down right now. So the price action that we're seeing to the downside on AMC isn't really AMC related at all. All we're actually getting is really, really good news about the company coming out every single week. And that honestly just kind of furthers my thesis and conviction in the stock, thinking that, well, the market is just not reflecting all available information. But again, that is just my own opinion. So let's get into some of the things that we need to understand first before we start talking about this forced share recall situation and why the data is starting to really turn in our favor, like we have seen it happen before in last January of 2021 and right before that big June run. So this is a paper that we brought up a couple of times. We haven't looked at it in a while, but I think this is really relevant information to those of you guys who are new to the channel. So right here, this is a research report done by some professors at the University of Notre Dame. A few recent papers, including Engelberg, Reed, and Regenberg, and Andrews, Lundblad, and Reed, have examined short selling risk, but while these papers examine the impact of short selling risk on stock returns and market efficiency, this paper studies what makes stocks risky to short. Short selling risks are tied to utilization. Now, a key point on utilization here is that what you're looking at, the actual number of utilization can change of what it actually means due to institutions buying more shares, increasing the denominator of the equation, but more on that in a little bit. Or the proportion of shares available to lend that are actually on loan. To proxy for the risk that a loan recall may force a short seller to close a position, I use an equal reduction in shares available to lend and shares on loan on the same day. For most stocks, this is a rare event. For easily borrowed stocks, I estimate that a forced share recall occurs once in about every 8 years. For stocks with utilization over 75%, forced recalls occur once in about every 28 days. So utilization is strongly associated with recall risk. Now, some people don't necessarily still understand what exactly a forced share recall is. It's not by AMC, it's by the people who are lending out these securities or those people who own the securities that may not actually know that their stocks are being lent out. So when we come over to this BNY Mellon report here, it's actually called like Dispelling Myths on Short Selling and Securities Lending. And right here, lenders can recall their securities whenever they want, for whatever reason they want, and they do not have to provide an explanation. All they need to do is ensure the request is made in good time so that we do not interrupt their investment life cycle. So right there, we have kind of that utilization risk with the shares on loan and what could happen with a forced share recall. And we have BNY Mellon coming over here and basically telling us this can happen at any time. But let's get into the actual data here. So for AMC specifically, when I shrink my window down to actually look at or text right here, the numbers kind of get a little bit jumbled up. But what we're seeing here is a pretty significant increase in the shares on loan. We saw back in November, the shares on loan was 86 million, and now we're seeing it all the way up to about 127 million, what we're seeing here. Shares on loan is actually the number that I want you guys to pay more attention to rather than utilization, because utilization is not really telling us a whole lot, especially if it's not really affecting the cost to borrow. Oh, but wait, now we're seeing a kind of uptick in this cost to borrow on AMC. We've been seeing those numbers of 1.47% average, 1.52% average, really kind of popping up at the end of the day for the last couple of weeks, but now we're starting to see it come up, and that's due to these shares on loan drastically increasing. So we've seen this go up to about 129 million, but we've seen it a lot higher in the past at about 152 million. But when we come back here, this is going to say May 15th is the low of shares on loan. It's actually, or March 15th was the low of the shares being out on loan, 63 million. It's actually March 18th with about 58 million when you expand this window a little bit. And what was the share price doing of AMC on March 18th? Well, when we come back to 2021 over here, we can see that it's the literal top of that run after that big January run up. So what we're looking at here is, one, we're starting to see the shares on loan kind of make higher highs and higher lows starting to come up. Now that does make a lot of sense with honestly what we've been seeing with the price action. They're selling a lot of shares into the open market, increasing the short interest, but eventually this cost to borrow is going to start to step up like we've been saying, and that's what we're seeing here. Now with utilization being said it's at about 100% by Ortex, we've seen S3 partners kind of come out and tell us that it's around like 85%, 83%, but think about that. It's still above that 75% threshold that was outlined in that Notre Dame article. Now, I'm not giving a time frame on this because it's just a research report. It doesn't mean that we're going to see a recall in the next 26 days, but it does increase the probability for some of these shares to get forcibly recalled. Now, here's another thing that I want to look at here. When we look at GameStop, it's coming up very significantly in terms of the shares on loan. So when we go back to August of 2021, there was about 7.15 million shares on loan here. But over time, we've shot all the way up to about 19 million shares on loan. We're sitting right now at about 18 million. But we can see that when shares on loan starts to go up, cost to borrow lags a little bit, but the cost to borrow is shooting up here. But the interesting thing about this is, well, where are they getting these shares from? A lot of people like to say that these institutions are loaning a lot of these shares. When we look at AMC here, it does make a decent amount of sense. Oops, sorry about that. It does make a decent amount of sense that some of these institutions are loaning out shares, just looking at the net inflows and outflows of institutional purchases over the last couple of quarters. We have 370 million bought, 13 million sold in Q1 of 2021. Then Q2, 1.2 billion bought, 409 million sold. Then 820 million bought, 33 million sold. Then Q4 of 2021, 247 million bought, 43 million sold. So we're seeing institutional net inflows into the stock. For GameStop, it's a little bit different. So when we see over here, it's institutional outflows is what we're seeing here. They're not really buying up this stock. So it would suggest that retail is owning GameStop. Now, why would retail allow their shares to be getting sent out on loan? That doesn't make a whole lot of sense. Are they naked shorting? Is it somehow coming up into this report that we're seeing here? So this kind of begs the question, well, do people have share lending turned on? Are these shares getting used against us? And then when we think about a share recall from that perspective, well, all that needs to happen is people need to turn their share lending off if they don't want their shares getting sent out on loan. But here's what we need to look at here. In general, when we're looking at these situations as a whole, we're seeing the cost to borrow go up, we're seeing them attack the stock, and in my opinion, it's only a matter of time before these institutions are going to see too much risk with the cost to borrow skyrocketing eventually on these stocks, and they're going to have to recall some of these shares. And in general, guys, I know it's kind of disheartening to see the price of the stock that we really like to talk about and we see has a lot of potential really trending down over the last couple of months. But again, I've told you guys kind of my opinion on this in the past. There is nothing that mainstream media can do. All of these FUD articles, all of these short sellers coming up, these shills coming out in our live chats that can really say anything to me to really change my thesis. And here's why. I've done the research into this. I've followed this company for a long enough period of time to kind of understand that it's, in my opinion, only a matter of time before we see a price movement back to the upside. And when you look at other stocks that have similar situations to this, that have played out in the past, specifically Overstock, when the short interest continues to be high, you see that volatility in the stock. Again, it's only a matter of time for another run. So that is really going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I'll see you guys in the next video.